It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, semiconductor shortage. What was initially expected to abate late this year, the shortage of critical chips may last until 2023, according to recent reports. Hardest hit among industries with chip supply issues is the auto industry, with Ford, Volkswagen, and Daimler, among others, struggling to maintain capacity. It appears the short supply of chips is being exacerbated by a shifting mix towards electric vehicles. Those hoping for a reprieve on rising new and used car prices may be waiting longer than expected. Also, these shortages may have knock-on effects for other industries from iPhones to gaming consoles. Most importantly, while many believe inflation is transitory, lasting supply chain issues could continue to fuel rising costs and drive Fed policy towards tightening financial conditions. Number 2, GDP estimates. This past month saw a number of major banks cut their forecasts for Q3 GDP estimates. Goldman saw a reduction to 5.5% from 9%, Morgan Stanley to 2.9% from 6.5%, and Bank of America to 4.5% from 7%. The theme was a softening consumer after a weak jobs report in August, in addition to fading fiscal stimulus. While consumption in the U.S. has returned to the pre-COVID trend, with the Delta variant and emerging Mu variant, some coming softness in economic growth is expected. A hiccup in the back half of the year may pressure the ambitious earnings estimates for Q3 and Q4 of 27% and 20% respectively for the S&P 500. If earnings were to disappoint on weaker economic growth and consumer spending, we would expect a risk-off move into the fall on the back of strong gains for equities year to date. The S&P 500 is up over 20% thus far in 2021. Number 3, valuations. With a yield on the 10-year Treasury at 1.35%, stocks still appear relatively attractive to bonds. However, if rates were to rise, we could see questions develop around already stretched valuations for the market. On a price-to-earnings basis, the S&P 500 trades at 27 times, a level only seen at the height of the tech bubble. This compares to a median of 17 times earnings. Against sales, the S&P 500 trades at over 3 times, which compares to 2.2 times in 2000 and a median of 1.5. Finally, Warren Buffett's favorite valuation indicator, the total market cap to GDP ratio, is at never-before-seen levels at over 200%. This is essentially comparing the value of all stocks in the market to the size of the economy and indicates significant overvaluation. While growth expectations are high and may justify elevated prices, we believe caution is warranted. We also caveat this with our belief that there remain a number of stocks that are undervalued in the market in spite of steep valuations for the market broadly. And that's been your Market Minute for the month of September.